And as much as I understand the monetary markets, the silver markets themselves as they are now, silver producers would understand them better than I do. And the fact they're not hedging means something. It means they do not believe on it, that the silver market can head much lower than it is now. And you know what? Neither do I. We got a lot to cover today. First of all, physical premiums are higher than they were during the March 2020 crash, which is when silver went down to, I think, 1050 or some ludicrous number. The premiums now are higher than that. And the spot price back then was 1050, and now is closer to 20 with the same premiums. Second, registered silver supplies have dipped below 60 million ounces for the first time since 2018. And I believe, my theory is that this has to do with the high premiums, because in order to capture that premium, you take supply out of storage and you give it to the mints to sell coins at the 35% premium. And who is responsible for elevated premiums? I believe it's the silver squeeze crowd. Third, we have the fewest short positions ever by the gold and silver producers. We have real, true deflation of the money supply, or better yet, called the credit supply. Real quarterly drop in the credit supply, deflation in monetary terms for the first time since September 2008. Watch out, equities. And finally, will gold and silver stocks crash along with the general market this time? I'm thinking no, because the crash seems to already have happened, and this time is going to be a little bit different. On that topic, I'm going to share a comment made by a long-time endgame investor subscriber with decades of trading experience, and we'll get to that at the end of the slide presentation. This silver report is brought to you once again by Fortuna Silver Miners, symbol FSM. Earnings will be announced on August 10th at market close. Fortuna's balance sheet and finances are equipped to deal with low gold and silver prices. The situation we are in now is much different than where we were during the 2012-2013 crash, when miners were not prepared for a fall in gold and silver as happened in those years. Now they are prepared, and Fortuna is prepared. Yeah, its earnings will be impacted by low gold and silver prices, obviously. No one can deny that. However, that changes when the price of gold and silver change. And so now, if you can get past the negative emotions and wondering why gold and silver cannot seem to climb from here, eventually they will. And when that happens, stocks like Fortuna will climb out of the gutter and probably reach new highs, especially when the Fed turns around for one last time. All right, guys, so here we have the junk silver premiums, 90% legal tender pre-1964 coins. The current premiums for junk silver coins are 35%, 34.83%. This is above, you can see the red line I drew here, the parallel red line on the current premium. It is above the March 2020 premiums for junk silver, which means the premiums now for a price that is about 60% higher than the depths of the 2020 crash, the March 2020 crash. Silver prices are not going down, they are going up. They're trending up. Yes, there is a decline. I'm not denying it. There's a decline. I'm not denying reality. But the trend from lows is up, higher lows, and you know where we go from there. And now, I'm going to try to connect this up with those premiums. I'm not sure if I'm correct on this, but it is a theory and it would make sense. Registered supplies are now down at the COMEX, meaning these are the stocks that are sold against futures. They are down to 57.77 million ounces. It keeps trending sharply down since silver squeeze here at 152 million ounces. We are down 62% in registered supplies since silver squeeze. That is an amazing accomplishment. We just need to keep going. Now, why would registered supplies continue to fall like this? There could be a lot of reasons, and I admit I don't know all of them. But one possible reason is that because the premiums are so high at 35%, it makes economic sense to take silver out of storage or to take it off of the futures market and sell that supply to the coin suppliers to make coins out of it and sell it and take that premium. If that is indeed what's happening, then as long as the premium stays elevated above 20, 25, 30, 35%, we should continue to see falls in this registered supply until we reach record lows and maybe beyond that. Record low is 20 million in 2016. Let's see how low we can get here. Next, Steve Kranzler talked about the COTs a week or two ago on Arcadia Economics, and it continues to get ridiculous here. we have the fewest short positions ever by the producers. The producers, the silver producers, are, of course, the miners and the merchants and processors and all those kinds of people that depend on the silver price for their sales. And so they short futures in order to hedge their revenues. What we're seeing among the producers now is the lowest short position ever by producers in the history of the silver futures market from what I can see here. I can't go back before 2006, it looks like, which means the producers are not interested in hedging their revenues because the silver price is so low. Why would they do it? It's even lower. It's much lower than it was at the March 2020 lows. And as much as I understand the monetary markets, the silver markets themselves, as they are now, silver producers would understand them better than I do. And the fact they're not hedging means something. It means they do not believe on it, that the silver market can head much lower than it is now. And you know what? Neither do I. Now, these are two charts I wanted to share with you that I edited a little bit from Gold Charts R Us. This is the cumulative deliveries of gold and silver supplies or warrants delivered from 2006. And you can see here from 2020, as deliveries spike higher, meaning the slope of this line heads a lot steeper beginning in March 2020, and that slope has not really slowed down on that, meaning gold deliveries continue to increase faster and faster and faster. And it's the same with silver deliveries, except a little bit more subtle, but you can see here that the slope has indeed increased in silver deliveries. Gold is going to lead here because gold is basically the money and silver is the money for the public, and gold is the money for the banks, and the banks are more involved in deliveries than the public is, obviously. What is more important, I believe, something that I just noticed today. I looked at the long-term chart of total gold supplies on the COMEX, going back to inception in the end of 1974, beginning of 1975. That is when the gold futures markets came into existence. Now, we see here that somewhere around December 1977 to January 1978, there was a huge influx of physical gold supplies into the COMEX from about, let's say, 500,000 ounces to what looks like 2.5, maybe 3 million ounces. I can't really make it out. It was an enormous increase, biggest increase up to that time. And we see here a very similar move in March 2020 when the total gold supplies in the COMEX just tripled, or even quadrupled, you could say, from March 2020 to April 2020. And why was that? Because the price of gold on the COMEX was much higher than the price of gold internationally, and so gold was flowing in. It was just a question of closing an arbitrage. That's what it was. But the question is, why was gold flowing in to the COMEX here? And does it have anything to do with here? Now, I can't say for sure, but 1977, 1978, December 1977, January 1978 was the beginning of the gold parabola into 1980. And there were corrections between 1978 and 1980. It's not that there weren't. There were, and some of them were very scary. But still, the quintupling of gold took place in those 2 years, and that is a fact. And of course, silver hit $50 back in 1980. Next thing I wanted to cover is, I covered this, I think, in 2 or 3 silver reports ago. However, we are officially in monetary deflation, meaning a lower money supply, or more accurately, a credit supply. The total M2 credit supply in banks in the United States is now contracting on a quarterly annualized basis. So if you take the average money supply over the quarter and you subtract the change from the previous quarterly supply and annualize that difference, we are shrinking on a quarterly basis for the first time since here, September 2008, where it just dipped below zero right here. And obviously these dips below zero happened after the crash had already taken place. This time, stock prices are still extremely elevated despite falling from highs in 2021. And so if these numbers are correct, we should experience a crash in mainstream equities anytime between now and October. And finally, a comment from an old-time endgame investor subscriber that I wanted to share here. I said in one of my reports this week that, quote, "It is possible the mining stock crash has come early this time, preceding the general market crash rather than being coincident with it. History rhymes but never repeats exactly." Am I 100% sure about that? No, I'm not 100% sure about anything other than the end game is that the dollar will die. And so because mining stocks have done so poorly without a concurrent market crash, it might just be that the crash is now over. And even if general equities fall, it might not affect gold and silver stocks this time. So my subscriber here gave a reason. He says, anyone who has seen any charts of the 2008-2009 financial crisis knows that the mining stocks went down with all the rest. Obviously, he's right. I can recall this was not so widely expected in 2008-2009, which is indelibly printed on my memory, as I was heavily invested in premium mining stocks at the time. If it's not expected, that means more people are invested in those stocks because they want to defend against a crash, but it didn't work, at least not in the short term, because those stocks, the PM mining stocks, fell with the rest of the market at that time. Now, that also happened in 2020. So now we are primed for people to believe that gold and silver mining stocks crash along with the rest of the markets. Maybe sometimes they do, but not when everyone's expecting it. Third bullet point here, most folks who would have previously looked at mining stocks as safe refuge positions in a crashing market no longer do so, and have and are selling those positions if they have them. And I admit that includes me. I also believe that gold and silver mining stocks are very prone to a crash if there's a general market crash. I still own them and I still buy them on the dips because they will recover first after the Fed pivots. But I admit, I might be wrong about the timing of this. The crash might have already occurred, and it might be time to go back into gold and silver mining stocks now at these incredible lows. And think about it. If gold and silver mining stocks don't crash along with the general market this time, it would shock almost everyone, including the gold and silver bugs.